what we're going to do is Chapter 19, the multiple choice questions, CPA questions. We'll do those. We'll do those first. And then we'll start in on Chapter 6 evidence, which I really cut down quite a bit. So hopefully it's a little bit more manageable. I've taught this before, and the evidence chapter can kind of get out of control, but I've cut it down quite a bit so that hopefully it'll be a little more manageable this time around. But we'll see. All right, so you should, I know what I want to show you. What am I doing here? Oh, I know what I gotta do. I put something, I put the under the email link, I also put Office, Microsoft Word, and Excel and PowerPoint in there, just if you want to click on those too. You can also get those through the email account, but I just kind of put them out separately in case you wanted to do that. Okay. All right, so let's go to multiple choice CPA questions. Now, here's the funny thing about this. There's 12 of them. So I'm going to have to give you guys 2 polls. One poll for 1 through 10, then another poll that will say 11 through 20, but you only need the first 2. So 11 through 20, we'll just do 11 and 12, and whatever goes on the other ones. So there'll be 2 polls coming in. Yeah. I can launch these simultaneously or not. Nah, that's not going to let me. Oh well.
So do we just do the first 10 questions, or?
Yeah, do the first 10, and let me see what the last 2 are. Maybe let's talk about the last 2. Yeah, just do 1 through 10. We'll talk about 11 and 12 separately. So it's 1 through 10. That'll be fine. Do something. Fix my mouse. My mouse set up so it clicks too much. Okay. Anyone still working on this? If you are, that's fine. I'm just asking if there anyone who's still, excuse me, still working on it. So if you're still working on it, either say something or send me a chat message. You can do a private one if you like. Okay, I think I already said.
I'm done.
Okay, cool. All right. And we'll share results. Okay, these are tough. Number one, I thought this one was going to be a tricky one, but you guys got it. This is it. B is correct. Why? Because it's payable. It's contingent on something else happening, and it's an audit. So that is a contingent fee. And contingent fees are allowed except in a few certain situations, one being audits or any kind of a test function. Second one being for taxes. And the third one being for making financial statements based on, and the idea is that it can't be contingent on something else. You know, that it can't be, so in this case, if they get the loan, they'll pay the audit. If they don't get the loan, they won't pay for it. That's a contingent fee, so they can't do it. You guys got it. Okay, oops, number two. Very good. CPA violates the professional code of conduct. They can do everything except you can't take away the license. Why? The state gives the license, not the AICPA club. Which probably will say be a conflict. I got that one. Let's go to number 4. Let me do something here. 4 back up on the right page. How about? All right, number 4. Which of the following circumstances would a covered member be considered independent? Okay, the first one's obviously out. Covered member spouse is a covered member. It's the same as a covered member. Covered member is on the board of directors. Can't do that. The entire CPA firm is not. Yeah, immaterial, direct, indirect, financial. Yeah, it's D. And you guys got it. Number 5. You guys got it. B. And if you look at these, you kind of know this because our covered members, remember for the consulting firm that they had the partners and the manager, 10-hour people. I never talked about this one. This hit me. Okay, I'm gonna talk about this one. Professional corporation, it's a form of a business. It varies by state, but there's also rules for the AICPA about it. So let me, I apologize for that one, but yeah, I should have, I don't think I talked about that at all. Did I talk about professional corporations? Okay, so it's kind of like this. Generally, if you are a professional, you form partnerships. You can't have a corporation. You can't limit your liability. That's why you have malpractice insurance. So if you're in the professional category, doctors, lawyers, therapists, other people with CPAs are in there too, you'll notice that they're almost all in partnerships. There are other forms though they can take, and that's what we're going to talk about now, but you cannot generally have a corporation that limits your liability. They don't want you doing something, if you're a doctor doing malpractice, someone sues you, you close the business, open up another one, because it's a corporation. So they don't allow you to do that. You have unlimited liability. Because of that, they're mostly in partnerships, and they talk about like law firms. They're a law partnership, making partner in the law firm, that sort of thing. There's a problem with partnerships though, in that partnerships, here, let me show you. Partnerships, when a partner comes into a partnership or leaves a partnership, the partnership dissolves. So it's kind of like this. If you have partnership A. Partnership A has Amy and it has Bill. Kathy joins the partnership. This partnership's over. We have Amy. We have Bill. And now we have Kathy. So this partnership is over. It ceases to exist. Okay, Bill leaves. This partnership's over. We have Amy. And we have Kathy. It's a brand new partnership. It'll cease on, and so whenever you add or take a partner away, it dissolves the partnership. Now, if you only have 2 or 3 people or whatever in a partnership, a small number of partners, it's probably not that big a deal. It probably doesn't happen all that often. But you take a large CPA firm, one that has 100 partners or 200 or 3, whatever it is, you're going to constantly have people coming in and out any given year. There'll be people coming in, partners being made, there'll be partners leaving, retiring, whatever. It's going to happen. So instead of having a partnership form and dissolve 5 times a year, what they do is they make a professional corporation. That professional corporation, it varies by state, but it's basically for the profession itself that anyone in that office generally has to be, a majority of them have to be whatever it is. So for instance, if it's a CPA firm, most states will say that a majority of them, or 2/3 of them must be CPAs or whatever. The AICPA is more strict. They're saying that if you use, if you used any of their materials in your firm, basically, and you're members of their firm, everyone who is in that firm has to be a CPA. So according to the AICPA, and by the way, you're taking the test made by the AICPA, according to the AICPA, that it is a violation of the rules if anyone in that corporation, anyone that is in there, is not a CPA. So here's how they do it. just like a company has shares, if you become a partner in this professional corporation, they give you shares. So they say, okay, here's the shares, and you're now a part owner in a corporation, just like any other corporation. When you leave, they take the shares back. Okay, we're taking back the shares now. You don't own it. You're not it. So it keeps going because it's a corporation, but it just makes the transfer of ownerships and interest easier if it is. They still have unlimited liability. They still have all the things that go on with a partnership, but it just makes it easier for the transition that you don't have a partnership dissolved, 6 times a year. It just keeps going and continuing as a corporation. The shares of ownership are owned for different lengths of time is the only difference. But you guys get it right. So what am I talking about? All right. So again, this is, notice it says according to the AICPA. The reason I say that is because some states allow for other people to be in there, but if you're a CPA firm, you can't do it. Seven is a tricky one, and yeah, you guys got it right. Yay. Eight, yeah, right. D would be correct, but it'd have to be with the client's approval. So the client would have to approve it. You can make journal entries, just you can't put them in the, they do the posting will be done by the client. Good. Yeah, this one's kind of hard. And this is the first one. There's the tricky one. That's kind of what they're hoping to trip you up with. Material investment, which the CPA is not aware. You're not aware of it. Okay, let's do 11 and 12. You guys got all the points for it, by the way. So 11 and 12. Any ideas on these? And think about this compared to, say, a doctor.
Independence.
Yeah. If you're a doctor, if your kid falls down and gets hurt, he wants a Band-Aid, yeah, I can't do that. Well, we're related. It's a professional service. You can't do that. So independence is the big one. Most other professions, that's not a problem, but it can be more so for audit for CPAs than anything else. Okay, Jones. Which the following is least likely to any ideas? Oh, come on, somebody. Which one do you think it is?
investment in the mutual fund.
Yeah, and the mutual fund would have a direct interest. So you buy a Standard & Poor's 500 mutual fund, the fund itself will directly buy, you know, IBM, for example. Yep, so that's it. Okay, so some like these or similar to these will be on the test. There'll also be quite a few like the ones we went through. Wrong thing here. What do I do with it? Oh, here it is. You know, these kind of questions will be, there's something similar to these, probably maybe not the same layout, but something similar to it about, you know, here's a scenario, is this allowed? Here's a scenario, is this allowed? There'll also be one on the hiring of CPAs. This gets tested quite a bit. The employment of covered members. You go from being a CPA. Usually they did about going from a CPA firm to the client, although it could happen the other way too. They can ask anything, but they usually CPA exam a lot of times will have this kind of stuff in there. Again, there's different rules. Non-issuers, you have to be taken off the audit if you're considering it or have accepted it. Issuer, same rules, but also if it's a key position, you have to be off the audit cycle for an entire year, which could be virtually 2 calendar years, depending on how, you know, how when the offer is made. So anyway, there'll be some of those independence ones on there too. Okay, let me save these results. Save file. Second. Starter file. Okay. Okay, next thing we're going to go into is the evidence chapter. I think I told you guys I really cut down. I'm trying to get this one to be a more manageable thing. Because it's on evidence, it could be on, you know, all of auditing is getting you evidence. You know, you base your audit report on evidence. So everything that you do is basically evidence. And so this can become a pretty big chapter. But anyway, I've cut it down some, so hopefully it'll be a little easier to go through. Oops, not that. Oh. Okay, and this is when we get into the assertions, and these are kind of tricky. And you guys cannot see my screen. No, that's okay. I got to talk about it anyways. The assertions. The assertions are what you audit to. When someone hands you the financial statements, there are certain things that they're basically are going along with those financial statements that are either explicitly laid out or implied. For instance, if they give you the financial statements, it's implied that they're complete. That, you know, they have all the sales and they have all the assets, they have all the other stuff in there, the liabilities, all that. That's one of the things. It's implied that that things exist, like the assets. If they hand you the financial statements that have those assets listed, it's implied that those are there, that they actually exist, right? So there's a lot of things that are implied when you're handed those financial statements, and that's what we're talking about, is what those things are. And whenever you do an audit, you audit basically to these assertions. So virtually anything you do in auditing is going to apply to these assertions. And the AICPA a lot of times will kind of hit these, and be very specific about what you're testing. It is possible that that more than one assertion is hit at a time, but for the most part, they lay these out so that they are usually one of them. Okay. So these are the assertions: occurrence, completeness, authorization, accuracy, cutoff, blah, 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 blah. You guys can probably read just like I give, but probably better. Okay, so let's kind of go through these. We'll talk about them and then we'll put them in. Which is most likely related to an occurrence? Now, an occurrence usually relates to the income statement. That something occurred. For instance, a sale occurred. Or it could be an expense of something that incurred, a loss that incurred, or whatever. But it's an occurrence that something occurred. Usually, you're usually looking at the income statement when you look at this one. Okay. Oh, that looks terrible. Hold on. Being tortured by Microsoft formatting. All right, there we go. Okay, so you're trying to prove that something occurred. Any ideas on these? All right, I'll tell you what, I'll cut it down a little bit. I'll show you too that it's not. How about that? Verify the individual purchase transaction was recorded properly. Okay, well, we're not talking about if it was recorded. We're talking about if it occurred. And whether it was approved or not, we're also not looking at that. So it's not going to be E or D. Which leaves us with these two. Now, when we talk about the occurrence, so basically we're saying, okay, like for instance, they had sales. Okay, how do we know that this occurred? Let's say there's an individual sale. They made a sale on June 14th, whatever it is. How are we going to see if that is, that actually occurred? How do we know they didn't just make it up? What activity are we probably going to do? A or C?
Verify that it's been shipped.
Yep. Yeah, if they're saying it's a sale, well, we want to see if it's been shipped yet. Now, notice this is kind of going in the other direction. If you inspect bills of lading, there might be still fictitious sales that don't have a bill of lading, but if you're doing from the bills of lading, you won't know that, right? I mean, if there was something they put on the books fictitiously that, you know, if you go from the bill of lading, it's not going to have a bill of lading because they made it up. So bill of lading is, you know, when you ship something, you have a bill of lading. That is going to tell you if something's been shipped. So when you go to the customers, you look at the revenues, you say, okay, I'll pick one of these out and trace it through and see if there is a bill of lading. If there's no bill of lading, it's, you know, going to be very likely that it is a fictitious sale, unless they picked it up themselves or something. Okay. Which activity is most likely related to completeness? Okay, and saying that everything is included in the financial statements. You know what? I should put something in here. I think. I know what to do. New plan. I got it in here somewhere. Do me a favor and go to page 3, types of evidence. And let's go to number 1 here. If you go from source documents, like bill of lading, to the financial statements, are you checking to see if it's complete or if there's existence? So I take my bill of lading. This is on page 4. Am I looking to see if they exist or if it's complete? So I grab a bill of lading. I see that, you know, I go down there, here's the completed bill of lading. Okay, I look at it. And now I'm going to take that and I'm going to trace it to the books. What am I looking for? What am I, you know, what is it either corroborating or refuting? What's the function of it? I'm doing that. Is it to see if the books are complete or if the sale exists? Either completeness or existence. So this first one here. So I go look at the bill, I go look and see what was shipped. And now I go and see if I can find that in the books, in the general ledger, in our accounting stuff. Which one do you think it is, completeness or existence? Oh, come on.
Existence.
Actually, it's going to be completeness. You're going to see if they have recorded everything that they shipped. You know, that if they shipped something and didn't record it, you know, for whatever reason, maybe they don't want to pay taxes or whatever. So this will be for completeness. So source documents, you want to see that everything that you have in the source documents is actually shows up into the on the books. Well, you can probably guess if this other one goes the other direction. You take it to the books and you go, okay, there's a sale here, you know, or it could be, you know, purchase or whatever it is. I'm going to go backwards and see if I can find the source documents. So for instance, let's say they purchased inventory. I want to go back and see if there's source documents for this inventory. Maybe they're just trying to inflate their inventory to make their income look lower. That's for existence. And it's the same way down here. This is for tangible assets. So for instance, if they have a piece of equipment on the floor, you go, okay, let's go look. Here's a drill press I find. Let's go find it in the financial statements. So this one would be similar to the first one, in that, you know, floor to book is you're seeing it is complete. Books to floor means there's stuff on the books that you trace and see what's on the floor. So, okay, they have this drill press on the books. Let's go find it on the floor. You want to see if that drill press exists. And I can tell you that from, from practice and everything else, it's more likely to have this not exist than it is the other way around. Usually when they buy something, you know, there's all kinds of invoices and all that kind of stuff. There's all kind of documents, but when they get rid of something, a lot of times they just push it out on the dock and, like, you know, scrap guy comes and picks it up. So a lot of times you think that there's something that's on the books that isn't. But anyway, yeah, so this is the, oh, I did that. Get that wrong. Oops. Okay, so let's get back up here. So which of these is probably completeness, that we have everything on the books that should be on the books?
Is it A?
No, that's not a bad one, though. I mean, it just has to do with assets that you're trying to verify to see if they have it in there.
Is it C?
Yep. Yeah, you take this stuff on the floor. You got this inventory. Okay, if this inventory is on the floor, I should be able to trace it into our into the general ledger. I want to see if it's complete. Do they have all the inventory listed? Right, so, yeah, that would be the completeness one. Which activity will most likely be related to authorizations?
It's C.
Yep. Yeah, so you know, and again, this intrinsic that you think that any sales and all that would be authorized or whatever. Number 4 is a fairly new assertion. And this one is not for overall accuracy. This is for individual transactions. Okay, individual transactions. So this is for, you know, you never say that the financial statements are accurate. You say, you know, reasonable assurance about whether they're free of material misstatement. You never say these are accurate. But there is the assertion that any single transaction that it's done accurately, right? I mean, so if you know, any given transaction, there would be the assumption that it would be made accurately. That, you know, that is again for the individual transaction, not the overall for the company. All right.
Either A or B.
It
C,
actually,
D.
Yeah, it could relate to either one of those. Yeah, actually, D is the one that is probably the most. But you're right that, and again, some of these can be more than one. And I think I told you this, but unfortunately, the AICPA, their directions for the test are pick the best answer rather than, so you can actually have 2 or 3 answers that are correct. But they want you to pick the best one, which is a judgment call. Anyway, yeah, so again, this is for individual transactions. They're reported properly. So which of the following is related to cutoff? And cutoff just is trying to get the correct transactions in the correct period.
No, Kai. See? No, don't sit on it, Kai. Right.
Okay.
Is it C?
Yes. Yeah, you're going to affect the bill of lading at year end. So the bill of lading that you find at year end, those should be in sales. Now, it could be that you don't have a bill of lading for some of the sales, or that there's bill of ladings that are not listed in the sales. So you actually could have we used to call this either existence or completeness. Now they call it cutoff. But you're basically looking for those things that were shipped get included in the year. Those things that were not shipped are not included in that year. So you're looking at the cutoff. It usually goes by the bill of lading. It has to be shipped. If it's not shipped, then there's no way the customer owes you, right? I mean, if you haven't shipped it yet, until you ship it, they don't owe you. I think there's something weird with the spacing on this. Sure. Which of the following is most likely related to classification? Okay, that making sure that it's in the right class. This one is probably the trickiest of all of them. Which of these would maybe be a problem with classification of it? The classification might be wrong.
Is it C?
No. Let's see here. Oh, okay. I mean, it could be if they have if the disclosures weren't appropriate, but that would usually be, yeah, it could be more of an accuracy thing in the presentation.
A?
A or B, yeah.
It's actually B. If accounts receivable has a negative balance, is it accounts receivable? No, it's a payable, right? So this one is the one, because if it's got a negative balance, so instead of the client owing us, we owe the client. Well, if we owe the client, it's probably not an accounts receivable. And it's accounts payable. So this would have to be reclassified as an accounts payable rather than subtracting from the accounts receivable. So that would be a classification. So even though they classify it as accounts receivable and it's in their accounts receivable system, it's really not accounts receivable. It should be classified as a accounts payable. Okay, let's stop there. Let's take a break. And then we will come back and do some more. Okay, let's take a break. We'll say be back at 7. What time you guys want to come back in? We'll say 7:10. Get up, walk around. All right. Gotta get doggy on here. Okay, coming back to let me get rid of this. Presentation and disclosure. This relates to the format of the financial statements. Format of the financial statements of the footnotes disclosure. So what you don't want to have someone do is or sorry, company do is to have something that is misleading. For instance, having something that looks like a revenue that's really a liability or something like that. So the format of the financial statements, and then also that the footnotes need to match up with the financial statements. All right, so and so when you talk about presentation and disclosure, you're really looking at kind of it's what it says, kind of like the overall format of it. That it looks reasonable and it actually conveys what it's supposed to convey. Okay, so number 7, which one is it?
B.
All right. Yep. Yeah, the footnotes, the disclosures of the inventory valuation should match up with the way they actually are doing the inventory. Which activity is most likely related to existence?
D.
I didn't write this very well. Actually, D would be completeness. I wrote this bad. This is. This first one is the first. Yeah, it's the first one here. This shouldn't say verify. This should say trace or something. Let's change this one to trace. I redid this handout. I always redo my handouts, and sometimes I don't do it very well. So just change this one to trace. Trace the equipment listed on the general ledger. To the equipment on the plant floor. So in other words, the stuff that they have on their equipment on the general ledger, we should be able to take those and go find them on the floor somewhere. So if they say that they have, 5 drill presses or whatever, you can go out on the floor and find those 5 drill presses and that sort of thing. And like I said, it's much more common to have things that are on the books that are no longer there. Sometimes people in production, they all get, this, we do with that old drill press. Just put it in the alley, let the scrap people take it or whatever. They don't actually fill out the forms and all that kind of stuff. So a lot of times you will find stuff that, especially if you're doing auditing, one of the things you do is you go through the older equipment and trace that to the floor, because that's more likely the stuff that they're going to have on the books that really isn't there anymore. So you look at the older equipment. Newer equipment, you still look at those, but usually there's like a ton of, there's all kinds of receiving reports and invoices and purchase, or there's all kinds of documents that go with those. Whereas disposing of something, a lot of times there isn't. So yeah, it's BA. Okay. Oh, wait a minute. What did I do here? I don't know. Which the following will be also be related to rights and obligations?
Only B seems to be correct.
Yep, it is B. So if they have something on their books for Based on vehicles. So if they have something on their books for vehicles, then they should own them. Right, they should be the owners of them. It could be possibly there's loans on them, but verifying with the titles of it, it could be leased. It could be leased equipment, and it could be that they, if it's not a capital lease, that they don't own any of it. And that could be for the building or anything else. I mean, you check to see if they actually have owners of it, and that'd be if they have the rights to it. Obligations are liabilities that, right now, so you check they have a liability on it. So it is possible that even though they don't own it, that it's a capital lease, and in that case, they'd have an obligation of the capital lease. A capital lease is just like a loan. So, you have to kind of see if just because it's on the floor doesn't mean they own it. I guess that's what I'm trying to say. Roundabout way. Which activity is most likely a valuation?
Is it A?
Yes, it is. Yeah, you want to evaluate these accounts receivable. So make sure that that expense is reasonable, that they've taken into account the economy and past experience and all that kind of stuff. Number 11 is a little bit tricky in that it assumes that you would know what an which things are allocations. And allocations
Is it B?
yes, it is. Usually things like inventory, depreciation, amortization, those are things get allocated. For example, if you have you buy inventory and you pay the shipping charges, that gets allocated to that inventory. You take the shipping charges and somehow divvy it up that it gets put into the inventory. There's other allocations too, but and depreciation is an allocation. It says, okay, this machine is going to cost us so much over 5 years. How much is it each year? That sort of thing. So it's an allocation. And allocations, might as well put this in now because you could get tested on it. They must be systematic and rational. That's not how you spell rational. I'll spell it that way. So, I know you were my student. Okay, so systematic and rational. Systematic means it's repeatable with the same result. That if you do depreciation straight line for 10 years, you get the same result as if I do it, straight line for 10 years. It'll be the same thing. And rational just means does it make sense. So anytime you have an allocation, whether it's for inventory, depreciation, amortization, those are the criteria. It's systematic and it's rational. Okay, and by the way, these kind of steps here, if they don't make too much sense, it's just one of those things that the more you kind of look at them, the more you get familiar with it. It's just a familiarity thing more than anything else. Okay, so these are all for the AICPA. PCAOB has kind of a cut down amount of standards. These are the standards way back in the day when I went through. These are the ones that we had. And you'll notice that there are some things that aren't on here. Accuracy, for instance, isn't on there. Cutoff isn't on there. And not that those aren't covered, it's just that those are generally stuffed into these other categories, especially the things like the cutoff. That we usually had that, for existence or occurrence and completeness would be cut off. They also may even use it for valuation, depending on if it's a like an intangible thing or like insurance or something. But anyway, so they have much fewer things, but they basically test the same thing. Okay. Time for something a little bit more definition-y stuff. Definition of audit evidence. Oops. So audit evidence is anything that corroborates or refutes a relevant assertion. And those are the assertions that we just had on, we just talked about. These. So audit, definition of audit evidence, anything that corroborates or refutes an assertion. So when we test from floor to book for completeness, that's testing a management assertion. When we do our test, it's either going to say, yeah, it's right, or no, there's a problem with it, or that it's not, they're not all there. It may not be material, but you're looking for anything that corroborates or refutes a management assertion. If it doesn't do either of those things, it's not evidence. So what that tells you is that basically everything is based on those assertions. Okay. Question on that thing? Sufficient appropriate evidence. Okay, what does sufficient mean? You say you have sufficient evidence. What does that mean? So we have to have a sufficient appropriate evidence.
Material.
It's a it means do you have enough, right? I mean, if you say you have sufficient. So for instance, if you have sufficient clothing to go outside, it means you're dressed warmly enough or whatever. So sufficient means do you have enough, and it's a quantity. And what do you think the appropriate means?
relevant.
Yeah. Yeah, that it's relevant. It's sort of it's a quality. That, you know, it to be relevant, you have to get enough. It's basically this, you know, this is what it is in layman accounting guy terms. You have to get enough good evidence to form an opinion. If you don't have enough good evidence, you can't form an opinion. So also your audit can only be based on your evidence. It can't be based on anything else. It can't be based on promises or you know, someone holding you harmless for whatever. It can't be based on anything else but your evidence. So you know, so if you can't verify someone, you get something, you can't have the client say, well, I'll put it in, I'm on the hook for that one. It can't be like that. It has to, your audit report or opinion, same thing. These are used interchangeably. Can only be based on audit evidence. Don't have the evidence, you can't do it. You have to have enough good evidence. You don't always have to have the very best evidence, but you have to have enough good evidence that you can make a report. Okay. So relevance. There are a few different things that go into relevance, and relevance means that it has to be the evidence has to must relate to the audit. There's a time element that's in there too. There's also a number of different things in there. It could be materiality, for instance, as far as how someone books something. For instance, I got this paper clip. This paper clip costs 2 cents, but it's going to last for 5 years. So do I depreciate the paper clip over 5 years? No. You know, materiality would say, okay, instead of doing that, we'll just expense it because it's not worth it. So there's a time element, there's materiality, there's a few other things that are in there that, you know, for things that are relevant to the audit to make it useful to the audit. Reliability of the evidence. I think we talked about this. Didn't we talk about this? Created by and held by? I think we did.
No.
No. I was teaching this class. Okay. Evidence. The best evidence is created by a third party. So not the client, not the auditor, but a third party. And it's held by a third party. So this would be something along, there could be a few different things. It could be confirmations. The confirmations that are sent directly to the auditors. That would certainly be one of them, but anything that's held by a third party, that's created by a third party, held by a third party, it could be correspondence with lawyers and other things. But this is the best evidence. Oops. So for instance, a bank confirmation that's sent directly to the auditors. Next best evidence. Third party held by the client. Example, an accounts payable statement. So they order inventory, and every month they get the statement from the third party, whoever they're buying the inventory from, and on that it'll have their what they owe. So accounts payable statement coming from a vendor and going to the third party, coming from a third party going to the client. Why, if it's made by a third party, why is it part of the best evidence? Why does it matter if the client holds it? What difference does it make? What difference does it make to the client? What difference does it make whether you got it from the third party or you got it from the client? Think sinister. Think sinister, evil people. That's what I like to do. Whenever I meet somebody, I assume they're sinister and evil.
They can change the numbers and
You can change the number.
manipulate it.
Yeah. Yeah. It's one of those things that they can actually change it. And a lot of times people can do it so well that it's almost impossible to tell. I actually saw a forged student transcript one time. that literally, their GPA was like 2.0 or 3.8, or we were looking at it thinking, okay, how come there's all these D's and C's in there? And it had been altered and it looked perfect. But yeah. Okay. The worst evidence made by the client. Oops. By the client. And this would be the worst. For instance, client invoices. A client can print out an invoice, basically. So, say worst. So that's the worst evidence. Now, it is possible, though, to try to move things up. And we'll find out, for instance, client invoices. Those would be like accounts receivable. We can actually do confirmations on accounts receivable. We renew the accounts receivable chapter next. We'll see how you do that. So it is that you can try to move some of these things up. So just looking at the client invoice, you go, okay, this is not very good evidence, but we can possibly turn it into good evidence by taking the client invoices, sending letters to their customers and saying, is this a valid invoice, basically? And hopefully the client, or hopefully the customers will send it back saying, yes, it is, or we're making corrections on it or whatever. But we can actually move evidence up, and we're always trying to move evidence up. The bank confirmation. That's something that can get moved up from being sent to the client to being sent to the auditors. We move it up. So it's kind of like I'm making evidence better than at least it was originally. Okay. Effectiveness of internal control. And that is, can you rely on the internal control for as part of your evidence gathering? If you can rely on internal controls, that will help you be a more efficient audit. Notice though, it does not say necessarily that the controls are efficient. The controls might be inefficient, but as long as they're effective. Now, there's nothing wrong with being efficient, but they don't have to be. When it comes to bringing an inventory into a place, there's usually 4 steps in bringing it in. I'm not going to get into it too deeply, but I did go to a place. We did do an audit one time where they had 16, and it was a nightmare. it did. It was effective, and that the stuff that came in was actually being entered in the system and all that kind of stuff. It was terribly inefficient, but was effective. Okay, this one, an auditor's direct personal knowledge is better than evidence received secondhand. So if you are doing calculations, if you're observing those types of things, reperforming the different tasks, the things that the auditor gets directly are more persuasive than things that are obtained otherwise. So it's sort of like the old thing, you believe your eyes more than what someone tells you. That the evidence that you get directly. So if you're, they may tell you, if you talk to somebody, they may tell you how something works in the factory or whatever. But if you go observe it and it's not done that way, that's more persuasive than asking somebody. And that's one thing that sometimes you run into a problem. They say, well, didn't Sarah tell you how this doesn't, what Sarah tells you may not be the most persuasive. Your own observations are more persuasive. Your knowledge that you obtain directly is more persuasive than anything you hear from somebody else. Okay, documentary evidence. I think I'm going to put these two together. Documentary evidence, this is to support now, documentary evidence, you gotta be a little bit careful on this when you're collecting evidence, in that you always make copies of the original documents, but you never accept copies of the documents. This is a terrible sentence. And feel free to clean this up however you need to make it make sense. So when you're looking at documents, oh boy, I messed it up. You never accept copies as the evidence. You always want the original documents. Once you get the original documents, now you can make copies of the original documents for your own records, but you can't accept copies from the client. You get the originals, then you make the copies for yourself to fill in your files or scan them in for yourself. Now, original documents must be returned to the client. You cannot keep original documents. So I say, well, how about if they don't pay you? What are can you hold on to the documents if they don't? No, you got to give them back the original documents. Anything you have with the bill is something different. Okay, we already talked about this a little bit. Inspection, we talked about this. You inspection of the documents, look at the documents, and the documents should be able to be traced to the general ledger, or from the general ledger to the original documents. It usually goes both ways, no matter what it is. You go from source to I'm sorry, I'm distracted because I can hear my dog chewing on the windowsill upstairs. Bad dog. It's yell at it. I still have a microphone I can yell at the dog with. But anyway, yeah, so you go both ways. So you go from the source documents to the general ledger to source documents. The same thing for tangible assets, except that you generally go to the floor. And now remember, there's also though that warning about ownership. Just because it's on the floor and you can trace it to the books doesn't necessarily mean they own it. So you look for title of it. Observation. observing controls being used is more persuasive than documents or inquiry. I think maybe I told you this before, but when I was doing auditing, if you look at the audit steps, a lot of times they'll say become familiar with their guidelines for internal controls. So you go get these big books and they'll say what they're supposed to be doing. After a couple audits, I realized that those books have nothing to do with it, and even talking to people. And it's not to say that they're being bad. So a lot of times they'll tell you something and you go observe and it's completely different. It's not that I say it's not that they're trying to mislead you. Usually it's just that they think that that's the way it's done, or that's the way it was when they were doing it, or whatever it was. That, you know, a lot of times you will find that what is written down or what you ask people is not what's being done. So you observe them. By the time I was, I've been auditing for a year or two, I wouldn't even look at those. I wouldn't even look at any of the manuals or anything like that, because more often than not, they were wrong. You're just wasting your time to start documenting that, and then to figure out that, okay, this has nothing to do with what we're doing, what relates to the audit. So a lot of times I would just go observe. That would be the first step that I would do, is we'll see what are these people actually doing. And once I figured out what they were actually doing, then I start to kind of fill in the blanks and figure out, why they're doing it this way and all that kind of stuff. So anyway, observation is a really good one. It can be awkward, watching somebody. You try to do it as nonchalantly as possible, try to be as friendly as possible, make them feel, that as comfortable as possible, not, but again, watching what they do. And this every time, every now and then I say, okay, why did you put that over there? Oh, okay. I was just curious. It sounds kind of funny because it's, when you think about auditors, you think about these, number of people coming in. But actually, the best auditors are the ones that really talk to people and watch stuff and observe them. That's really how you find out a lot of how things are actually done. Okay. Inquiry is just asking people. Talking to people. I should say employees. And just my own observations is that talking to the people that are actually doing it is much more informative than talking to their supervisors or people, higher up. That's not an AICPA thing. That's just my when I was doing audits, a lot of times the people that are actually doing the work are the ones that are the ones that are more likely going to give you more relevant evidence that you need. Confirmations. These come directly from third parties to the auditors. So bank cutoff statement, bank confirmation, end of the period bank statement, accounts receivable confirmation, accounts payable confirmations. There's all kinds of these confirmations you have, and generally they come from third parties. And again, you're trying to move evidence up that list. So the client hands you an invoice, terrible evidence. They could have just printed that out. But you can take that invoice, put it in a letter, send it to it as a confirmation to their customer saying, is this invoice valid? You actually owe this amount. And that when they send that back to you, they'll give you evidence that'll corroborate or refute that that's a valid accounts receivable. Recalculations. Recalculations can be basically you're doing the calculations the client would do, but you're doing them separately. And you're doing that because your calculations should match up with theirs. So if they do depreciation, straight line basis over whatever, whatever period of years and all that kind of stuff, I should be able to do that recalculation and come up with the same numbers or something that's not materially different from what they did. Okay, so recalculations are usually done for could be bank reconciliations. Two L's in there? No, there are not. Bank reconciliations, accounts receivable, bad debt. They'll say, okay, we assume that this many people learn. They'll show you how they came up with it. Depreciation. It could be a number of them, but these are kind of the ones that they usually are common to recalculate. The reason being is that they have big ramifications. So bank reconciliation, we'll do our own bank reconciliation, and then we will compare it to what they have. Accounts receivable, bad debt, whatever they came up with, we should be able to recalculate that and come up with the same thing. And depreciation is a common one. So if they're using double declining balance or they're using straight line or whatever, we should be able to do it just like they did it and come up with the same or something very similar to what they have. And this is good evidence because this is from your own personal knowledge. This is what I do with it. This is this. So it's more persuasive for me to do the bank reconciliation than to see the client's bank reconciliation, right? It just kind of intuitively makes sense. If I did the bank reconciliation, that carries more weight than their bank reconciliation because my own personal knowledge went into that bank reconciliation of how to do it. Reperformance is similar, but usually you're reperforming the controls. It's right, isn't it? Reperforming. If I do this, we'll make it. Okay, we'll do it that way. All right, I don't know if I told you guys this or not, but which one is left here? Okay. I think I told you that when I was at auditing, for whatever reason, I was the inventory expert guy. I think it came about because I think on my first audit, I helped somebody with the inventory because audit's kind of big, or inventory is kind of big. So then after that, I kind of every time we got to know it, this guy knows inventory. So at the end, I was inventory guy, and it's one of those weird things. I have no interest in inventory, but that's what my specialty, which is kind of funny. It's kind of like, you know, in your career, you don't really, you know, you never sat in the back of class and like, man, I'm gonna be inventory guy when I get, you know. So anyway, they had a problem with the inventory in one of our warehouses. It was up in Canada actually, and they had put a new accounting system in. Have I talked about this? I don't know if I talked about this yet or not. But anyway, they put a new accounting system in. Now, new accounting systems are always dangerous. New any kind of system is dangerous because a lot of times you won't know exactly what they're going to do. As much as you test and retest and all that kind of stuff, sometimes when you get into it, things just happen. And that's what happened up there. They took inventory, and the inventory, you know, the inventory was more than what they had in the books, which is really unusual. Usually inventory, just because of breakage, of theft, you know, something, you know, whatever, things get thrown out. Usually inventory is less than what's on the books. Not always, but not significantly usually, but you never get more. It isn't like somebody walks in and hands you more inventory and walks out. But that's what that's what was happening. They had this inventory that when they took inventory, they had way more inventory than they thought they had. And I think maybe I talked about this before. Any ideas on why that happened? Or how? How did they magically get more inventory? You know, what was a failure that they had? I don't know if I talked about this before or not. But.
Maybe something with FIFO and LIFO. They changed it.
Could be. That could definitely be a change in the inventory, because when you see companies change from LIFO to FIFO, a lot of times they do have these big adjustments that they go through. It actually had to do with returns. On the returns, they would credit the customers, so the customers would be happy, right? They, okay, you know, you returned it. Here, we're giving you your money back for this, or crediting your account, or whatever it was. You know, so they didn't have to get any complaints on the customers, but the inventory that was returned was never put on the books again. So, you know, this is like for trucks, so brake pads or whatever, you know, whatever came back was reshelved, but never actually put into the accounting system. So anyway, we went there. So we were trying to figure out how it gets in and why and all this stuff, and we're getting all kinds of, you know, oh, it does that. Oh no, it doesn't do that. You know, all these kind of things. So finally, I was not leading on the audit. There was a different guy that was my supervisor. He says to me, okay, go back there and find, you know, do some returns and just go through and do them just like they do them. Well, these people are on these, it's a warehouse, so they're on these lifts that go way up and way down, you know, they're like 30 feet in the air and stuff. I'm like, oh man, I didn't want to do it, but I ended up doing it. And thankfully, nothing went over like 10 feet or something. I'm riding this thing up and I'm holding onto it for dear life. But anyway, yeah, it was a reperformance. I was actually doing what they did to try to figure out why this stuff was supposed to be getting put back in, and it wasn't. It had to do with they didn't put anything in the system until it was shelved, but the paperwork for shelving it was not always returned to the right spot. Basically, that it was they had a couple different scenarios of where they should put the things, and so long story short, they weren't putting it back in inventory until it was on the shelf that they could actually have someone go and get it. But once it was in there, there was no, the follow-up wasn't always complete as far as putting it back on the books. But anyway, but it's through this reperformance thing, part of it was going through it. And it's kind of funny because that's a union job. And so I was like, okay, I got to get approval from the union to do this, because they don't just want management coming out and doing their work. They get irritated by that. It's kind of funny though, because the union guy's like, yeah, hey, you can do my work. Okay, well, that was easy enough. But yeah, so it was a reperformance thing. But again, it's shelving return inventory, just because we had to figure out what was going on. And again, new system, everybody was even people that thought they knew it were now all shaken and not knowing what was exactly happening. And so anyway, reperformance was definitely helpful in that one. Analytical procedures, I'm going to skip that one for now because I got a thing at the end of this that will go over it. We're pretty much out of time. So I'm going to finish up this last one. So we're scanning for data. One of the things that you'll end up doing is scanning the books. Unusual transactions. And what do we mean by that? Round even numbers. A lot of times you see numbers like 10,000 even. Most business transactions are not done in big round numbers like that. Loans are not done in big round numbers like that usually. Nothing is done in big round numbers. So look for big round numbers is one of the things you look for. Another thing you look for are transactions that are not routine. For example, a sale that isn't in a sales journal. So, most sales will go through the sales journal. You have a sales journal, the journal will feed into the general ledger, right? Well, if you have a sale that doesn't go through the sales journal, that's unusual. There might be a reason for it, but at the same time, those are the things you investigate because that is unusual that a sale would not go through the normal channels. And so much of accounting is, not necessarily, I don't say automated, but that so much that goes through these special journals that you're also going to look for manually entered journal entries, things that are manually entered, where you actually write out the journal entry. Those are not as common as ones going through journals. So anytime you see an entry that is seemingly plucked in there somehow to whatever account you're looking at, those are things that raise your attention. Those are things that have a larger potential for problem. If for no other reason, a manually entered journal entry is more likely to be wrong. People make mistakes more often than computers do. So a manual journal entry is one of those things that has all those, all the frailties of the human condition are in there. That you're tired or whatever, you put it in wrong. But it could also be other things too, though, that reasons why they're in there that are for bad reasons. But anyway, scanning the books, it actually a significant amount of fraud is found that way. Looking through the books, looking for big round numbers, looking for things that are not routine, unusual things, negative sales, negative expenses, all those kind of things that would, are eye-opening. And then also manual entries, things that go around the systems and are put in there by individuals. All right, well, I think we'll stop there. Okay, let's go back here. I think I'm gonna redo the chapter 19 exam. I will send it out tomorrow. will be due on twelfth. Okay, so chapter 19 exam, I will send that out tomorrow. And we do on Friday, November 12th. Any questions on anything? And we'll continue with this audit evidence. I don't think there's much left, but. Okay, there's a little more than I thought. Okay, well, have a good evening, and I will see you. So I'll send out the test tomorrow, and it'll be due in 9 days. Is that right? Something like that. But anyway, and we have class next week. If you have any questions on it, you can ask. Okay. All right. Good night, guys.
Good night.